Most traders misunderstand the hanging man. They see a hanging man after a bullish gap up and think the uptrend is still strong, but that's exactly where they get trapped. Hanging man plus gap up looks extremely bullish, but smart money may already be selling into late buyers. Let's break down the psychology behind this setup and why it can trap emotional traders near the top of the market. This is where smart money starts paying attention, because a hanging man after a bullish gap up can become an early warning sign that bullish momentum is weakening. On the surface, the market still looks bullish, but underneath, selling pressure may already be building, because without confirmation, there is no trade. Now let's break down what this price action is really revealing. So what is this price action really revealing? When price suddenly gaps higher, most traders become overly bullish. They see strong bullish momentum and assume the market will continue moving higher. They don't want to miss the move. So emotional buyers begin chasing price aggressively. This is called FOMO buying, fear of missing out. And most of these traders enter very late, right near the top of the market. But this is where many traders get trapped. Because while emotional buyers are rushing in, smart money may already be preparing to sell. And this is where the real trap begins. The hanging man becomes the first warning sign that smart money may already be distributing positions into aggressive buying pressure. The long lower shadow is important because it reveals that sellers suddenly stepped into the market during the session. Even though buyers managed to recover near the close, the candle has already exposed weakness behind the bullish move, and this creates a potential turning point. Control may slowly be shifting from buyers to sellers. But most traders still focus on the bullish gap up and continue chasing the market higher. And once price starts dropping, trapped buyers begin to panic. They rush to exit positions, adding even more selling pressure into the market. And that's how a bullish gap up can become a smart money trap. What looks bullish to the crowd may actually be distribution by smart money. And this is where the concept of an exhaustion gap becomes important. If you've heard the term exhaustion gap before, this is exactly the kind of setup traders are referring to. Because after a strong bullish move, the market suddenly gaps higher one final time. But instead of continuing higher with strength, the move begins losing momentum. This gap up can actually become the last emotional push from buyers, the final burst of FOMO buying, the last gasp of aggressive buyers near the top. And while emotional traders continue chasing price higher, smart money may already be quietly selling into that strength. That's why understanding the psychology behind the gap is much more important than simply memorizing patterns. And that's exactly why I'm creating these visual animations for you, so you can truly understand what the market is revealing instead of memorizing candlestick patterns blindly. Because in trading, understanding always beats memorization. And if you find these lessons valuable, feel free to subscribe to Market Structure Logic. We focus on understanding price action logically, not memorizing patterns mechanically. So now the question becomes, does every hanging man carry the same reversal probability? The answer is no, because context changes everything. And when a hanging man forms after an aggressive bullish gap up, the reversal setup becomes much more dangerous. Let's compare the difference. And that's what makes this setup more dangerous than a standard hanging man. On the right, a standard hanging man is already a warning sign. But on the left, when a hanging man forms after an aggressive bullish gap up, the reversal probability increases significantly. Why? Because the gap itself often reflects overextension, emotional buying, and aggressive late buyers chasing near the top. And once the market starts reversing, those trapped buyers often begin panic selling, which adds even more selling pressure into the market, fueling a much stronger bearish reversal. But here's something very important. Just because a hanging man appears does not automatically mean the market will reverse. And this is where many beginner traders make a costly mistake. They see the hanging man and immediately enter the trade too early. But disciplined traders understand something critical. The hanging man is only a warning signal. Without confirmation, there is no valid trade. So now, let's look at the most important part of the setup, the confirmation candle, because the hanging man, by itself, is still not enough. Now this is where confirmation becomes extremely important. It tells us buyers may be weakening, but it does not confirm that sellers are fully in control yet. So now, look at the next candle carefully. If the next candle starts breaking lower and closes bearish, that becomes confirmation. Notice something important here. Price attempted to continue pushing higher, but buyers failed to maintain control near resistance. That's where aggressive sellers started stepping into the market, and price immediately started pushing lower. This bearish follow-through is extremely important, because now the market is no longer showing bullish strength. It is beginning to show bearish weakness. Some traders prefer waiting for a break below the hanging man low, while more aggressive traders may use a break below the hanging man body as an earlier confirmation entry. That depends on your trading style and risk tolerance. But regardless of the entry style, the key idea remains the same. Sellers must show confirmation, because the hanging man alone is only a warning signal. But the confirmation candle is what tells us sellers are now taking control. And that is what transforms a warning signal into a valid trade setup. Now here's another important example to show why confirmation matters so much. As you can see, the first hanging man appeared after a bullish gap up, and many traders may immediately assume that the market is about to reverse lower. But notice what happened next. Price actually continued pushing slightly higher first, and if traders entered too early, they could easily get stopped out, because many stop losses are usually placed above the hanging man high. But then, a second hanging man appeared near resistance, and this time, the bearish confirmation became much stronger. Now sellers were showing clearer control over the market. This is why disciplined traders wait for confirmation. They don't rush into trades emotionally. They wait for the market to prove the reversal first. So always remember, no confirmation, no trade. Because a candlestick pattern without confirmation is still only a potential reversal, but confirmation transforms probability into a valid trade setup. Now there are also additional confirmation factors, like gap fill confirmation, gap down confirmation, high volume on the hanging man candle, and hanging man forming near major resistance or Fibonacci levels. We'll break all of that down in the next lesson, because in this video, we focus specifically on the psychology behind the bullish gap-up setup. And in the next video, we'll cover one of the most important execution concepts, hanging man plus gap-down confirmation, because that's where professional trade execution truly begins. So if you enjoyed this breakdown, feel free to subscribe to Market Structure Logic. My goal is to simplify candlestick psychology and price action, using visual explanations that are easy to understand, without needing to spend hours reading complicated trading textbooks.